Why isn't a dollar worth the same as a pound? They're both just paper or numbers on a screen, so why does one buy more than the other? It feels arbitrary, like some committee sat in a room and picked numbers out of a hat. But currency value has nothing to do with the symbol printed on it. It's about trust and what that trust can actually buy. Every currency is a stand-in for the country behind it. A growing economy, one that makes things people want and pulls in investment, creates demand for its money. More demand, more value. A struggling economy, one shedding jobs or flooding the system with cash it can't back up, loses that trust fast. And when trust drops, so does the currency. That's why exchange rates never sit still. A dollar might get you 150 yen this morning and 147 by dinner, depending on what's shifting in Washington or Tokyo. Trade plays a role too. If Japan is selling more to America than America sells back, U.S. companies need yen to pay their suppliers, and that demand pushes the yen's value up. It's a live marketplace, and currencies are competing in it every second based on performance, trade, and confidence. A dollar isn't a pound because America and Britain are different economies, running different amounts of money, carrying different levels of global trust. The number on the note is meaningless. The economy behind it is everything. Now, if every country owes money, who exactly are they paying? Because that's the part nobody explains. America owes money. So does China. So does Japan. Trillions, all of it. The answer is simpler than it sounds. They're paying each other, and they're paying their own people. When a government needs cash for hospitals or highways or the military, it doesn't fire up a printing press. It sells bonds. A bond is a promise. Hand the government $1,000 today, and in a decade, they hand you back $1,200. Regular people buy bonds. Banks buy bonds. Pension funds buy bonds. Other countries buy bonds. The debt gets spread across millions of lenders, which is exactly why it never collapses under its own weight. When America's debt sits north of $35 trillion, some of that is owed to American retirees, some to Chinese institutions, some to Japanese banks, and it flows both directions. China holds a huge chunk of U.S. debt, but America holds Chinese debt too. Nobody actually pays it all off. They refinance. Old bonds get replaced with new ones, over and over, forever, as long as people keep believing the interest will get paid. That's the whole trick. National debt doesn't behave like your debt. Nobody's repossessing a country. It only becomes a crisis the moment lenders stop believing they'll get paid back. Until that moment, the wheel just keeps turning. So why can't governments just print more and hand it out? Wouldn't that fix everything overnight? Here's the problem. Money is only worth something if it represents something real. Picture a small town, 100 people, 100 loaves of bread. Everyone's got $10. Every loaf costs $10, which makes it balanced. Now the government prints an extra $1,000 and drops it into people's pockets, which makes everyone richer on paper, but there's still only 100 loaves. Everybody rushes the bakery at once, and the baker realizes he can charge more. 10 becomes 20, 20 becomes 30, and nobody got wealthier, but the bread just got more expensive. That's inflation in miniature. Printing money doesn't manufacture value out of thin air. It just spreads the existing value thinner until it's worth less. Germany found this out the hard way in the 1920s, when people were hauling wheelbarrows of cash just to buy groceries, and a single loaf of bread cost billions of marks. The currency turned into scrap paper. Governments can print, but only safely alongside real growth, real output, more goods actually hitting the shelves. Print without that growth, and you're not creating wealth. You're manufacturing inflation and calling it a solution. What is Bitcoin, really? It's money that lives entirely online, no physical form at all, and unlike the cash sitting in your checking account, no bank or government is steering it. It runs on something called a blockchain, a public record that logs every transaction that's ever happened on the network. Send someone Bitcoin, and that transaction gets broadcast to thousands of computers scattered across the planet. Those computers, the nodes, race to verify it by cracking a math problem. Once it's confirmed, it gets locked into a block, and that block chains itself permanently to every block before it. Everyone can see the transaction happened. Nobody knows who actually sent it. Your identity hides behind a string of characters instead of a name. Because there's no single point of control, no one can freeze it, seize it, or quietly print more of it whenever they feel like it. The supply is hard-capped at 21 million coins, written directly into the code, which is exactly why people started calling it digital gold. But it isn't flawless. Transactions crawl compared to a credit card swipe. The price can swing violently in a single day. And because there's no customer service line, lose your private key and that money is gone permanently, no appeals process, no reset button. Bitcoin proves that trust can be built with math instead of institutions. Whether that makes it the future or just a volatile bet depends entirely on who you're asking. The ledger, at least, never lies. What happens if inflation flips negative? Falling prices sound like a gift: cheaper groceries, cheaper rent, everything a little more affordable every month. But deflation doesn't feel like a party. It feels like the economy holding its breath. Here's why it backfires. If you expect prices to keep dropping, you wait to buy. Why grab that car today for 30 grand if it'll be 28 in 6 months? This causes spending to slow down. Businesses see fewer sales, panic, and cut prices even further to chase buyers back in. But that only teaches consumers to wait longer. Demand keeps sinking, revenue keeps sinking, companies start laying people off to survive, unemployment climbs, and the people who still have jobs are now more cautious with money too. Prices fall harder, the whole thing spirals, feeding itself. Debt gets brutal in this environment. Borrow $50,000 for a business, and you still owe $50,000, except now your income is shrinking while prices around you collapse. The loan doesn't get smaller just because everything else did. Defaults climb, banks start failing, credit dries up. Japan lived through exactly this in the 1990s. Prices dropping, spending frozen, an economy stuck in place for decades. Inflation stings, but at least the economy's still moving. Deflation is what paralysis looks like wearing a friendly disguise. Who's actually footing the bill on tariffs? It sounds simple on the surface: slap a 25% tariff on imported steel, and suddenly the foreign country is the one getting punished. That's not how the money moves. The country selling the goods never pays a cent. You do. Here's the real chain of events. An American manufacturer wants steel from overseas, priced at $1,000. Because of the tariff, the government collects an extra $250 at the border, charged to the American company, not the foreign supplier. The overseas seller still walks away with their full $1,000. Now the American company has a choice: eat that extra cost and shrink their margin, or raise prices and pass it along. Almost every time, they raise prices. That steel ends up in cars, appliances, buildings, and the tariff rides along with it through every single product until it lands in your shopping cart. Sometimes tariffs do protect domestic industries, making the foreign option less appealing, pushing buyers toward homegrown steel instead. But even then, prices don't drop back down, because domestic producers know they've got less competition breathing down their neck. Either path leads to the same place: you paying more. Tariffs are import taxes, and taxes always land on the end user eventually. The foreign country walks away untouched. The cost just shows up quietly in your checkout. Why does buying a home feel almost impossible now? 50 years ago, one paycheck could cover a mortgage. Today, 2 incomes barely clear the bar. Home prices have sprinted ahead while wages jogged behind, and that gap has turned into a canyon. Back in 1970, the average home ran around $23,000, which adjusts to roughly $170,000 in today's money. Actual prices now average well past $400,000. Wages simply didn't keep up. A solid middle-class income in 1970 could cover a mortgage, groceries, and still leave room to save. That same job today can barely stretch to cover rent. Part of the squeeze comes from supply. Cities choke off new construction with zoning restrictions, endless environmental review, neighborhood pushback. So far, fewer homes get built even as more people need them. Limited supply, rising demand, prices climb. Then investors showed up. Corporations and wealthy buyers started snapping up homes not to live in, but to rent out or flip, treating shelter like a stock ticker. When Wall Street starts competing for houses, everyday buyers get shoved out of the bidding. Cheap borrowing made things worse, since low rates meant bigger loans, which meant sellers could ask for more, which meant banks approved even bigger loans, and the whole cycle kept feeding itself. Younger generations are now staring down decades, not years, just to scrape together a down payment. A house used to be where you built a life. Now it's a line item in someone else's portfolio, and the people who need one most are competing against people who already own 10. What's the actual difference between trading and investing? Both involve buying stock, but that's roughly where the similarities end. One is a sprint, the other is a marathon, and confusing the two will wreck you. Trading means buying and selling fast, chasing short-term price swings. A trader might be in and out of a position before lunch, or hold for a few days at most, betting on momentum, headlines, chart patterns. It's a game built entirely on speed and volatility. Investing means buying something and sitting on it for years, sometimes decades, betting on a company's long-term direction rather than tomorrow's headline. When the market crashes, the trader panics and scrambles. The investor sits still, knowing the market has recovered from every crash in history so far. Warren Buffett didn't build his fortune flipping stocks in an afternoon. He built it buying strong companies and holding them for 30 or 40 years without flinching. Trading demands constant attention and split-second nerve, and most traders end up losing money because timing the market consistently is nearly impossible. Investing demands patience and the discipline to ignore the noise, while compound growth quietly does the heavy lifting in the background. Both can build wealth. They just require completely different temperaments. One is playing the next move, the other is playing the long game entirely. How do wealthy people turn debt into more wealth? For most people, debt is something to fear: credit cards, student loans, a weight dragging them down. For the wealthy, it's a lever they pull on purpose. Say you're holding $10 million in stock. Sell it to fund a new venture, and the government takes a cut in capital gains, maybe $2 million gone. But borrow against that stock instead, using it as collateral, and you get the cash without selling a single share. Banks hand over the loan at a low rate because the collateral makes you a safe bet. You've got spendable cash, and you still own the stock, untouched, still growing. No sale means no tax bill. This is standard practice among the wealthy, borrowing against assets to fund lifestyle, launch new ventures, or acquire even more appreciating assets. The math works because the debt costs less than the growth it's sitting on. A portfolio compounding at 10% against a loan sitting at 3% interest nets, a clean 7% just from leverage. Regular people can't access this game. No bank is extending a multi-million-dollar line of credit against someone's modest 401k. Debt for the average person means high interest and mounting stress. Debt for the wealthy means leverage and a smaller tax bill. The system quietly rewards whoever already has enough to play it, while everyone else is left drowning trying to pay theirs down. And finally, how does money laundering actually work? It's the process of taking illegal cash and making it look like it came from somewhere legitimate. A drug dealer can't just walk into a bank and drop off a few million without triggering every alarm in the building. They need a story, and building that story happens in 3 stages. First comes placement, sneaking dirty cash into the financial system, often by depositing small amounts across dozens of accounts to stay under the radar, or converting it into expensive goods like cars and jewelry that can move through the system quietly. Next is layering, where the money gets pushed through a maze of transactions designed to bury its origin. Shell companies, offshore accounts, foreign banks, a property bought here and sold there, wired through 3 more accounts in between. Every extra transaction buries the trail a little deeper until investigators lose the thread entirely because the money's been sliced apart and reassembled so many times. Last comes integration, where the cash resurfaces as clean, legitimate income. Criminals fold it into real businesses, restaurants, car washes, real estate, inflating the reported earnings so the dirty money blends in with real revenue. Taxes get paid on it, and just like that, drug money becomes a paycheck. The whole scheme survives because the financial system is enormous and constantly moving. Millions of transactions a day, most of them completely ordinary. Hide inside that noise, and nobody notices a thing. Laundering was never really about hiding the money, It was always about hiding the crime.